These models are the ideal methods meticulously designed to operate entirely within the ethical and legal framework of Islamic finance, thereby avoiding any element of interest. We primarily see three main types of Islamic home financing models globally. The first is murabaha, often referred to as a cost-plus sale. In this model, an Islamic bank, acting as an intermediary, first purchases the property outright from the seller. Once the bank owns the property, it then sells it to the client at a mutually agreed-upon, predetermined marked-up price. This fixed price is then paid by the client to the bank in installments over an agreed period. The key here is transparency. The cost of the property to the bank and its profit margin are disclosed up front. There's no fluctuating interest. The client knows their total payment from day one. It's essentially a sale, not a loan.
Okay, a clear sale transaction.
Exactly. The second model is ijara wakina, frequently translated as lease to own or diminishing lease. Here, the Islamic bank leases the property to the client. The client makes regular lease payments, similar to rent, but a crucial element is that a portion of each payment gradually contributes towards the eventual purchase price of the property. At the end of the lease term, or maybe at agreed milestones, the ownership eventually transfers from the bank to the client. It's a progressive path to ownership where the client is essentially renting the property with the promise of acquiring it down the line.
Sort of building equity through rent payments.
In a way, yes. And then we have musharaka mutanakisa, or a diminishing partnership. I know. Now, this is widely considered the most authentic and preferred model because it most closely embodies the core Islamic principle of risk sharing and partnership. In this setup, the bank and the client co-own the property right from the very beginning. The client then gradually buys the bank's share of the property over time through installment payments. Simultaneously, for the portion of the property the client does not yet own, they pay rent to the bank. So as the client's ownership share increases, the bank's share diminishes, and consequently the rent portion also decreases until the client owns the entire property. It's a dynamic partnership that adjusts over time, reflecting true shared ownership and responsibility.
These models